What's really been driving the market and part of this responsible for AI euphoria, how that impacted not only the stock market, NVIDIA, or OpenAI is doing an investment.
The obvious mistake that I think people will make: volatility of the market, volatility of employment, volatility of the economy. Let's touch upon the interest rates, or inflation, the least amount of risk possible. It's that time again. It's time for the Wise Money Guys radio show, hosted by John Scambray and Giuseppe Visconti. We are certified portfolio managers that specialize in helping people who are retired or about to retire manage their money. As always, if you like the show and want to get on our calendar for a no obligation consultation, give us a call at 916-967-3500. And stay tuned for the whole show. I always like to recommend, because usually our meat and potatoes, as far as our best strategies, some of the things that we're doing and that we see
out there in the market,
we usually save for the end. So now, what are we going to talk about today, Giuseppe?
Well, a lot of activity that happened this week. We are in earnings season. We talked about that last week, but we had tech companies report this week, which is huge because it's part of the Mag 7, the Magnificent Seven, which is a big weighting on the S&P 500. What's really been driving the market and part of this responsible for AI euphoria. We had the FOMC meeting. So the Federal Reserve had their meeting, and Jerome Powell spoke on Wednesday, and he cut rates by 0.25%. We'll dive into that, how that impacted not only the stock market, but then also how did that impact the interest rates amongst the different loans that you can borrow, whether it's for a house, a car, what have you.
Don't forget the shutdown.
The shutdown.
Yep, the shutdown. Inflation. The current valuation of the S&P 500. Some of those things are starting to look a little bit concerning. Right. So we'll dive into the weeds on that a little bit. But you mentioned earnings, and it never ceases to amaze me, when companies report pretty good earnings.
What does amaze you?
Lots of things amaze me these days, actually. Well, these companies are just gigantic, and they report, meeting or exceeding expectations, and then the stock goes down. Well, right? Because I think it's an excuse for obviously profit taking.
Part of that, it could be. I think part of it too is that the stock, the stock of a particular company has run up. I mean, NVIDIA ran up to $210.
Yeah, and that's the one I was thinking of when I was mentioning that.
Yeah, so it ran up and NVIDIA has not reported earnings yet, right? So it's already running up because of some of these deals they're doing with these other tech companies, right, that are going to be investing in NVIDIA, or NVIDIA investing in them and doing some sort of partnership. So it's forward thinking. And so when earnings come in a little below estimates, then it's going to have a reaction to the overall price. So we saw, Meta, and the big thing with Meta is how much they're spending on AI, right? So they have to take that into account. That went down. I think initially after they reported, it went down after hours by 11%.
And they almost always drop initially. But
Google went up, though. Google crushed its earnings on both sides, and it went up. I think initially was like 5% after hours.
In that case, Google's very different, because Google was not trading at the multiples of like a Meta or an Amazon or a Netflix or those. I mean, when you look at some of the metrics like, profit to sales, those sorts of things are just simple, the PE, price earnings, not anywhere near the multiple that some of these companies have been trading at. And I think that's one of the reasons why you see the ones that initially pop, but then sell off, just because, gosh, how much overvalued or really stretched can they get in their valuation? And
you have two components happening right now, two things happening right now. You have the market, which is pretty stretched in valuation and how high it's gone, with relatively not much volatility here in the recent months. And then you have the individual companies themselves. So, and we've talked about this before on earnings season, that things have to just continue to go right? The earnings,
perfectly, really.
Yeah, the earnings, the profits, so on and so forth, whatever analyst comes out with estimates, like they need to be met or they need to be exceeded. And then the forward guidance as far as what they say on their earnings call, the company has on their earnings call of what they're projecting for the future or what they might be concerned with. There has to be everything that's going right. It's like a Goldilocks situation, because the market and some of these individual names have run up so high with all this. OpenAI is doing an investment with NVIDIA, or OpenAI is doing an investment with, and ChatGPT is doing an investment with Oracle. Oracle went up like 22-23% once that news came out. Now it's like, okay, the stock went up 22-23%. Now in the weeks coming, does it merit that 22-23% jump? And then when they do earnings, do the earnings represent, like, we can count on this jump of 22-23% from that initial news, that it looks like it's going to project, to come to fruition, or not?
The real $64 million question is, do you buy the dips of companies that report at least in line with expectations and then sell off? And my kind of philosophy is you don't add, more exposure to something that's already overexposed.
Yeah. I think what could be a strategy, and obviously this is not a recommendation because we don't know every individual person who's listening, your scenario, your risk tolerance, and so on and so forth. But it's the companies that get dragged down because of a company within its industry that reported, and for some reason that dragged that industry down. And so then you have some other stocks within that very same industry that their fundamentals could be absolutely solid and have great forward guidance, but they ticked down because of a big behemoth within that industry. So let's say like NVIDIA, right? Let's say NVIDIA reports, and right now you had like Microsoft, Meta, Amazon,
Google.
Google was up after the report, right? But Meta was down pretty heavy. Microsoft was down a little bit. Google was the one that was up green the day after all the reporting. Apple was a little bit down. But then you look at, okay, in that space, because there was some big behemoths that came lackluster and maybe dragged some other, that could be an opportunity where you say, oh, I'm going to add a little bit more to that name, right? Because they're fundamentally, we saw that with banking, right? In 2008, Bank of America went down to $3 a share, right? Wells Fargo was pretty fundamentally sound. JP Morgan was definitely fundamentally sound, but their stock prices had got decimated in 2008 because there's just a contagion effect, and it was a recession. So there was two big components there. But that was a time where you say, okay, JP Morgan's fundamentally sound. Their stock price went down so much because of some of these other banks that are defaulting or about to cease to exist. So that could be an opportunity where you add.
Yeah. I continue to think that the not so much the contrarian, but the end around is really kind of what you're talking about. The end around opportunities, meaning, you still have the big names catching all the headlines, driving a lot of, for example, you mentioned JP Morgan. If you look at JP Morgan and a few others, they drove, whether I think it was on Wednesday or Thursday, the Dow going up quite a bit.
Right.
It was just a few companies that did that. And so when you're looking on, okay, where do I put my cash if I'm worried that I'm not going to be participating in this market or participating in the potential projected growth of the market next year, to me, and going back to NVIDIA's of the world, well, I certainly wouldn't be comfortable, say, buying an NVIDIA right here. But then you look at companies like Core Scientific or Core Weave, for example, and I'm not saying buy those now, but the ones that, are run the data centers, have the data management, create the stacks of equipment, and then the other company, and these two specifically, that build the center.
Yeah.
And so
the brick and mortar part
so it's really about knowing how to find things that still have upside in them, and that takes a lot of time, effort, research, reading, listening, over and over again. So the obvious mistake that I think people will make here is they'll just pile in to Google, Microsoft,
the no names,
Meta, so on and so forth, when they're already stretched way out there. Could they go higher? Yeah, but I wouldn't really call them a momentum stock or something that.
No, they are.
Well, they did. That's what I'm saying.
They swing so much. But to your point, I had a conversation with one of our clients doing a review meeting earlier this week, and he was saying he's got an ex-brother-in-law, and he always pings him once in a while because he's got NVIDIA and Meta and some of these big names, right? And he says, you should have done what I told you. Look at how much NVIDIA has gone up and so on and so forth. I was like, yeah, but did he call you in like March, April, and May when it was down over 40%?
Yeah.
He's like, yeah, no. And I said, well, there's other names out there, right? Because you've told me this a couple different times. Yeah. I said, but if we look in your portfolio, from some of the models that we have and we implement with our clients, one of them was Western Digital, WDC, and literally from the model, right, it triggered to be a candidate to buy in August. And from August, and I showed him, I was like, from August this year until now, right, well, whenever I met with him this week, which was Wednesday, actually, it was up 84%.
Yeah. And that's and Western Digital is a great example of the end around.
Right.
And I think, we need to explore that a little bit more when we come back. You're listening to the Wise Money Guys, John Scambray and Giuseppe Visconti. Stay tuned. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray. I'm here with my partner, Giuseppe Visconti. And I lied because we already hopped into the weeds with some of the strategies and things
that we've seen in the market
that we're talking. We're talking to our clients about. So let's back up. I mean, because, economically at a macro level, I mean, there's some big things going on. I mean, like the government shutdown. Now, I think it will maybe have an effect on some GDP and maybe might have some effect on some of the consumption.
Well, November 1st is a big day, right? Because from my understanding, like EBT cards and
that's today.
That's today?
Yeah.
Today.
It is.
Yeah. I'm like, this week has gone by so fast. I mean, I was telling my kids middle of this week, I said, oh my gosh, it's going to be Halloween on Friday.
Yeah.
It's just
no, is it November 1st or was it November 6th? I mean, obviously we're not looking at things on the weekend, but where the SNAP program,
all that stuff
runs out.
Yep.
And so,
and just government employees aren't, that are furloughed. They're not getting
TSA.
They got paid in October.
Right.
But they're not getting, so now hopefully they have, that's kind of why it's important, and you see it and just reading articles in the past. I haven't seen an article lately, but just a savings rate that people have, they don't have much in savings. They don't have much in sidelines. We just actually talked to a prospect, which is potentially going to be a new client. She's going to retire in April. Most of her money is tied up in a pension. I think this is going to be a good topic to talk about in this radio show as well too. She has a healthy monthly benefit that she can get from her pension from Kaiser, but when asking what her other assets are, it's not a whole lot. She's got a 401k that wasn't so much built up for it because she put a lot of dedication in just working for Kaiser for so many years and raising her family. Right. She was a single mom, so good for her. But most of it, and so the discussion we had was, do I take the monthly benefit when I retire? But then the downside to that is that's what you get. You can't call, hey, Mr. Pension, I need $25,000 because something came up with my house or my car or whatever. You can't do that. So then we were discussing, well, another strategy because you have the option to do a lump sum rollover and put it into an IRA, and then you have full control over it. So we can generate the income for you, but then you have full control that should something come up, or the other thing is you pass away, what happens to your pension? Does it go to your beneficiaries?
Yeah.
Does it not?
In the case of where you're a single person and you don't have somebody of same age, because a lot of people don't know that. And now we're into a little bit more technical side of a defined benefit plan versus a defined contribution plan. A defined contribution plan being like your 401k,
right.
Defined benefit plan just being based on, compensation, age, and years of service, and that defines your benefit. The reality is that it's very expensive to pass on your income to an heir, even if it's your spouse, your partner, whatever the case may be, because now they're guaranteeing some level of income for more than one life.
Exactly.
And so when you look at a modified benefit, then it just really comes down to the math. And what we were showing this client is that, okay, if 5,400 is your unmodified benefit, that's the income you will receive from your pension. But if you die the next day after receiving one check, the money's gone.
Yeah.
The lump sum.
Nobody benefits from it.
History
from that point on.
And then people will think, oh, well, I'll leave it to my kids. Well, what happens is your kids are much younger than you. So their life expectancy from a mortality table is much longer than yours. So then they go, okay, great. Your unmodified is going to be 5,400, but now that you want to pass on your income to somebody who's 30 years younger than you, now your modified benefit is going to be $2,000 a month so that they can get $2,000 a month for the rest of their lives.
Right.
And these are all kinds of things that we look at and examine and run calculations on to determine, are you better off, taking the unmodified benefit, a modified benefit, which is just a different insurance choice, or rolling over the lump sum. And we'll be brutally honest. I mean, if you're in a position where the income that they're gonna pay you.
Yeah, let me just chime in real quick about the honesty part. Is initially when we were going through the numbers on our pension, because we kind of dove into that first, and we were doing the math on that, we initially said that's actually pretty good outcome.
Yeah,
and the rate of return was actually pretty good based off of the amount that you have in the pension of a lump sum if you rolled it over. But then when we dug further and had more discovery and found out her situation, the things that she wants to be able to do with her money, new car, her car is really old. She's going to have to buy a new car. She wants to help out some of her kids. And she doesn't have much
beneficiary her same age. Don't forget.
And that's important. It's important to build towards your retirement, but not just 100% focus on that. You have to have, because there are these scenarios like this government shutdown that you can never predict the future, but at least have a few months worth of expenses set aside in something.
Yeah, I really think it should be longer, right? The rule of thumb
was 3 to 6 months.
Was 3 to 6 months. But yeah. I really think probably nowadays, with volatility of the market, volatility of employment, volatility of the economy, volatility of geopolitical thing, on and on, you really need to have 6 to 12 months.
I guess it really depends.
3 to 6 months.
Really, I battle this. I'm probably more conservative than I need to be for my age, because I have, more than the 3 to 6 months set aside. But if I think back, what was the worst time in my life? That I lost a job and I needed to go find another job, right? Because that's what it really comes down to, is what if for whatever reason you have a situation where your income stops, right? And for some people now that are in government jobs, their income is stopping because politicians are fighting back and forth and can't agree. And they're not getting a paycheck in November. But, for me, it was 2008. I lost a job. I was a brand new financial advisor. I was on this new training program. So I was part salary on that. And they just were cutting expenses. And Bank of America bought Merrill Lynch, or, kind of forced to buy Merrill Lynch. Mm-hmm. And they let go all of us new guys. Yeah. Right. But when I think back on that, and as crazy as the market was at that point in time and high unemployment, it took me 4 months before I got a job.
Yeah.
So I'd say,
I think jobs are, if you've got a good job, especially if you're, a younger person in your 20s or 30s or even 40s, boy, you don't want to quit in this environment because, a lot of the hiring is some sort of government, or entity that gets its revenue from the government. It might be a good or services that's sold or contracted with the government. And so, boy, I wouldn't put myself in the job searching category right now. If I have a job and you're just maybe, again, you're younger and you don't like it, but that's a small, segment, and certainly not the segment that we specialize in helping, which is people who, are on passive finding jobs, people that are on passive income versus earned income, because that's all really retirement is do you have the ability to go to passive income from
what you say,
W-2 income or self-employment income, whatever the case may be.
Right.
And so does the government shutdown have an effect on that? Maybe. If it really did on, the majority of the country's economy, I don't think we would see, companies going up in spite of what's going on with the shutdown. And we certainly wouldn't see, luxury real estate just hit, some amazing growth.
You think government employees are buying luxury real estate?
They're not. That's my point. So the government shutdown, because it's more, it is white collar in a lot of aspects.
Yeah, I think the biggest is just depending on the percentage, and I don't know off the top of my head the percentage of government employees, and it's gonna hurt their spending, right? So, and we're in the holiday season now, so how long does this drag on for? And now that they're actually starting to miss paychecks, they're not going to be spending that money. So does it impact that next quarter of consumer spending? By how much?
At this number of days, it'll have no effect. But to your point, if it continues, it might have some minor effect.
Then they miss December's income. And
here's my prediction. My prediction is that this shutdown ends with a continuing resolution, which is what all these worthless politicians always do.
Kick the
can down the road. They'll go, okay, we'll get back to trying to pass a budget, which they haven't done in years and years and years.
Which is the bigger problem.
We've been operating on borrowed and printed money and CRs, continuing resolutions, where they just go, okay, we're gonna fund the government for a number of months, and then we'll battle it again in a number of months. So health-wise, we should not end the shutdown to just do another continuing resolution.
To kick the can down the road.
But my prediction is, because both sides will start going, oh, is this going to affect the midterms? Exactly. Are we going to lose our seat in Congress? Or
there's leverage to be had, and it's not really in the best interest of the citizens.
So, and that's what the mainstream media will start focusing on is, oh, you're not going to win if you're up for re-election.
It's sad. That's sad. That's BS, really.
Instead of doing your job, which is, let's finally balance the budget.
Yeah.
Because that's what this is all about. Right. That's why there's a shutdown.
Not focus on all these sound bites.
All these subsidies. So, Republicans want to get rid of the subsidies that should have been gotten rid of, years ago. Democrats not only want to keep the subsidies, they want to increase even more free stuff to people who don't actually pay in to our society. But at the end of the day, we're going to end up with a continuing resolution and kicking the can down the road. That's my prediction. The market won't really care either way.
Obviously, it hasn't.
And has not. And we'll keep talking to you and bringing you more wonderful stuff when we come back. You're listening to John Scambray and Giuseppe Visconti, the Wise Money Guys. We'll be right back. All right, welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray. I'm here with my partner,
Giuseppe Visconti.
And let's touch upon the interest rates or inflation, the FOMC,
Fed
the meeting,
inflation.
I mean, yeah, no, he's really starting to get beat up, more so now as he gets closer. Jerome Powell, the chairman, as he gets closer to not being reinstituted,
right?
Coming up in May.
I mean, if you were him, would you want to be reinstituted?
No,
I wouldn't.
But God,
does he need to?
Up these worthless Fed presidents, Fed board members. I mean, they think growth is a bad thing, right? Oh God, if you get growth, you'll have inflation. And that's just not the case. They don't understand the, supply side economics, and they should not have the mandate that they have. They definitely shouldn't have the power that they have. Because again, their job has become one that
do have a lot of power.
They have way too much
It's
power.
like He-Man. It's like the power of Grayskull.
Masters of the universe. But really, at the end of the day, what the Fed has done, through its errors, is they've really destroyed the dollar, and that's where we keep getting inflation mistakes, because at the end of the day, if you stabilize your currency, you won't have inflation.
Yeah.
And then you can have growth without inflation. And so I think the Fed needs to be completely revamped. But Congress can't even pass a budget.
What do you mean? Like a new ballroom and a new coat of paint?
Which now comes out, who one of the big anonymous donors was or is.
Who?
NVIDIA. What?
Jensen Huang?
Wong.
Oh, okay.
Yeah. 300 million of it is being paid
Ballroom?
for by NVIDIA.
Wow.
So, they're
dropping the bucket.
They're buddy, but it's just laughable. Now you got me on a tangent that, there's Democrats out there going, God, when Trump's gone, we're going to tear it down. But yet they don't look at the money that Biden spent, and more importantly, Obama spent on renovating the White House and what they did to it. FDR put an indoor swimming pool that was purely for his benefit, spending the equivalent of tens of millions of dollars.
Wow.
No, back then, people don't know that. So, presidents all have put money into the White House, but President Trump is the only one doing something for the White House that doesn't benefit him exclusively. The money that Biden spent, that Obama spent, going back to FDR spent, was to their benefit and paid for by taxpayers.
That's the big part.
So
that's the big part.
I mean, come on, Democrats, wake up.
The big part is using taxpayer money for stuff like that.
It doesn't matter what the guy does. He stops wars. No Nobel Peace Prize. He gets, companies, entities to spend money on our country, invest in our country. Nope. Still hate him. Still Trump derangement syndrome. It doesn't matter. But back to ground level.
Right. Back to the. So some of the takeaways I had from the FOMC meeting. One, and this has been plastered all over the place too, is the December rate cut. And so there was questioning around, the next cut, and he said that's not a foregone issue. Far from it. So market reacted negatively to that because it was pretty much baked in that he was going to do quarter point cut, which they did this week, and that there were going to be, high probability of quarter point rate cut in December, but that probability dropped from his, rhetoric from a speech on Wednesday. That's one. The other is you had dissenters on both sides of the spectrum of, rate cuts or no rate cuts. And primarily because they're battling because the inflation, that they look at is at 3% and it's kind of staying steady at 3%. And then they're looking at the labor force and the, employment environment. And that is still showing some softness, although we are currently at a really good rate of employment because it's at unemployment, yeah. Right, 4.3%. So I think he just did it as, okay, I'm going to throw another rate cut in there. I don't know if it's baked in. I mean, I didn't think he was going to actually cut this most recent meeting, and he did. We'll see what happens in December, but the market has been baking that in, and we have a little bit of a pullback and some volatility that spiked up a little bit in the market, and I think that's warranted, and I think it's needed just because it's gotten stretched too far. I mean, it's like 13% from its moving averages, so it just gets a little bit too stretched there. Individual names and the market itself. He did make a comment about .com because there was some questioning around like, do we think valuations too high? He says, I don't think that AI is the same as .com, with the spending and the profits
completely
that they
different.
have.
If you look at the .com industrial revolution, .com was very different because most of those companies, the only revenue they had was from their IPO and or any sort of capital raise, and their burn rate and their ability to survive because they didn't actually have a profitable product or company. I mean, that's why so many of those and the valuations that they received were just worse than just pie in the sky.
Right.
It was just nonsense. I mean, these companies were getting, $1 billion in their initial public offering, and they made nothing. The AI spend is primarily coming from companies that have billions in assets, billions in reserves, billions in profits, so on and so forth. So it's far different.
It is, but I think it's okay for the amount that they're spending, and the amount of infrastructure it's going to take, right? And the capital expenditures that's needed and that they've been doing. How much of that is actually going to turn into profits? And is it the right amount? Is it too much? Right. So part of why Meta went down based off of its earnings was one thing that was looked at was the amount of spend.
Yeah, it's spending right? Not in line with its rate of earnings.
So has the stock price got a little bit ahead of itself with all these, future projections of what it could be and do and so on and so forth. But then you come back to reality and say like, oh, we're spending a ton of money. Okay, well, what's your actual profit, from all of this so far? The other thing is OpenAI, and we talked about that before. They're making a lot of investing deals, but they're not showing much of a profit for as much as they're promising to invest in these companies over the next 3 to 5 years.
Their revenue has grown. They have found ways to remunerate its offering into a meaningful level of money. However, their spend is way out of whack compared. I mean, they're completely underwater, but yet the billions being thrown at company. That's kind of similar to the .com bubble. But right now, most of the spend is from companies who can afford to spend it.
And then the other part of AI,
which might hurt their stock price just because the increase in earnings and profits don't match the spend. But all that would mean is just a temporary, downturn in their stock price a little bit
until it catches up,
or they stop that same level of spending.
Right.
It's
kind of like the spending we've been doing in the country. Right. Does that slow down? Do we catch up at some point in time?
It never, not at the government level, not at the federal government level.
I mean, the difference is a corporation will start realizing it and then they start turning things around. Right.
That's the thing. I mean, a corporation is how the federal government needs to be run. It needs to be about, or at least run like, a personal household, that if you don't have money to spend, then
you can't keep borrowing it.
You can't. I mean, eventually they go, you're a bad bet.
Yeah.
Right.
Yeah.
And so,
your credit score is no longer 740.
Oh, the U.S.
That's now 620.
It's not even 620. It's like 495.
No, because if you look at it and figure all the assets, right? I mean, that's but yeah.
Well, and the fact that how much
that's actually a good idea. We should give a political credit score to all these politicians.
Right.
And they start off with a great credit score.
Right.
Right. Like an 800 or 850, whatever. Right. Mm-hmm. They start off when they get in office, but then through all of the things that they, from their efforts, whether it's some bill that they passed or some act or something that they, had some heavy participation in, of like, oh, we need to do this and raise taxes on that. Oh, we need to do this and have a bill and spending on this and blah, blah.
Yeah. We need to borrow money for this.
And just have just metrics, right? No rhetoric, but just metrics and data to say like, how well did that pan out? What did you tell the people it was going to do and what actually happened? And if it had a, if it didn't work out, if it fell on its head, like your credit score is impacted.
We're probably giving somebody a great idea and for an app or a website, whatever, because think about it. It could have a neat acronym like FICO, for example, or Fair Isaac.
HICO. Political interests.
Yeah, exactly. So, but that's the reality. The government needs to run more like a for-profit entity.
We are a for-profit.
Well, yeah. I mean,
that's what the GDP is.
Yeah. Well, but it's not translating into any common sense with, balancing the budget and spending more than we're taking, than the U.S. government is taking in.
Right.
And again, you can't fund the world's, lack of prosperity. Right. We have to focus on our prosperity and our citizens and our
just the frivolous
continue to grow and thrive,
and just the frivolous, wasteful spending, right?
Yeah, it's out of control. Well, all right. So at the end of the day, again, what's most important is how you react to these things and not panic or overreact. And we'll talk about that when we come back. You're listening to the Wise Money Guys, John Scambray and Giuseppe Visconti. We'll be right back. Welcome back to the Wise Money Guys radio show. I'm your co-host, John Scambray, and here with my partner, Giuseppe Visconti. And, my big concern about all of this is that people make the wrong decision when it comes to, timing investments. And
a lot of times it's emotional.
It's emotional, and it's the exact opposite timing that you should be utilizing, which is, most people, they get in now to things because, they're just like we're getting calls and going, I made XYZ, maybe it's 8, 9, 10%, but your example earlier, I see an NVIDIA or whatever is up 40% year to date. And then they buy into those things that have already run up. And then when something negative comes out and then they go down, then they panic and sell out. So they actually buy high and sell low here. And at the end of the day, there's always going to be good years. There's always going to be bad years. And it matters what you average through all of them, and to not overreact, but more have a goal.
Yeah. Not focus on one quarter or 1 year and build your strategy around that, or morph or change your strategy around that, because a quarter is like, oh, there's some names out there that just ran up in this last quarter, and now we're going to change our strategy around that, when your strategy needs to last you 20 years.
Yeah. It's funny. I had a client ask me about Illumina. I wish we would have stayed in Illumina. Well, when Illumina was down like 75% in 2022, he definitely wanted nothing to do with Illumina. And then it was down again in April of this year. Again, nothing about Illumina. But now all of a sudden, since Illumina is now back up, it's like, oh, we should have kept Illumina. And you can't,
hindsight's 2020.
you can't do those things.
Yeah.
It just matters overall. And this is a person that, is averaging per year, good years and bad years, over 8% cash flow on his money. And that is phenomenal. That's almost in line with what stocks average just from a price appreciation per year.
Long-term average of S&P 500 is like 9%. Right? Yeah.
And so
but you're just not having the roller coaster ride. And I think it's a good point, is because it's easy, especially in the good times and when there's euphoria out there and there's a name, and that's like what happened with .com, right? People want to pile in pets.com or whatever, right?
I remember pets.com.
Yeah. And I've talked about this example before. I had a client years ago who was working for Cisco, had a couple $1 million worth of Cisco stock, and was, pre.com or before the crash in 2000. And his wife told him, like, maybe we should sell some. Maybe we should. And he did. He's like, no, this is Cisco. Are you kidding me? And the stock was doing great. And Cisco's like was like the Apple back then of today. And man, .com crash happened, and he lost a ton of it. And it took forever for Cisco to climb back out of the hole that it was in. And that's hindsight 2020, right? So you don't want to change your strategy around because you're trying to chase something because of FOMO, right? Fear of missing out, or you just want to participate or what have you. You could do a small portion. If you want to take a small portion of your portfolio, and we've advised that to some clients who get really caught up with this. We say, hey, look, this is your financial plan. These are the goals that you're trying to achieve in the long run, and we're trying to build something that has longevity around it. Okay, we're not building something trying to chase like, oh, this stock or sector is hot now. Next month it's this, and next year it's that, or whatever. We want something that's going to do good overall, but it's going to go after achieving your goals and make you financially successful on average over a long term. Because if not, and you just get caught up in the moment, right, whether it's a month or a year or whatever, and you change your whole strategy around that, then there could be very well years or time periods where it's down. Then what do? Do you stick to it and say, I'm just going to wait till it goes back up, especially if it goes down 40% or 50% or whatever? Most likely you're not.
Yeah.
It's going to be very stressful.
So our humble advice is really based on the importance of having a game plan, a financial plan, knowing, a number or a need that's most important to you achieving, whatever your goal or objective is, and then building something, having something that is designed to accomplish that at the least amount of risk possible. So just simply have a plan. If you already have a plan, it's time to review that plan, especially as we go into the end of the year for obvious things like taking out your RMDs. How will that impact your taxes? What rebalancing should be done to lock in some profits, harvest some losses, and really set yourself up for hopefully kicking off 2026 in a good first month, good first quarter, because often how you begin the year really sets the tone for what type of year you'll have overall. So I highly recommend you come in for a no obligation consultation. Let us take a look at, what it is you've done. If you have a plan, we'll help you update and do a plan review. If you don't, we'll actually give you the questionnaire to create your first plan, all with no obligation. And how do you do that, you say, Giuseppe?
Well, how do you do that?
There you go. You call 916-967-3500. Again, that number is 916-967-3500.
Kathy will get you set up, and then we can send you a link with a questionnaire, and then that's how we can get started and set up a follow-up meeting.
So we're out of time. I hope you enjoyed listening to the Wise Money Guys. As always, have a wonderful afternoon. Come back and give us a listen next week.
Have a great weekend.